Hello everybody, and welcome to another week of Learn It Live. Today we're going to be talking about how professional traders use trading journals, and I'm joined as always with my illustrious colleague Tyra and Bella.
Hi everyone, and yeah, welcome to tonight's episode. Should be a good one.
Yes, it certainly should. Yeah, so it's one that I think a lot of people often overlook, but it's very important to trading. So let's get into it and get started. I think everyone's here, so that's good. Now, as always, if you want to ask any questions or you've got questions about, and I'll reiterate this throughout the webinar, but if you have questions, please put them in the channel chat, and then at the end, we'll try to answer as many of those as possible. So we'll try to get to those. Now, just to get started, I'd just like to read out the start of the risk warning. This information is being provided in these videos, will be produced by third parties and does not reflect the opinion of Pepperstone. So the information has been provided without any alteration or verification. So this is just the normal rules that we've got to put out. So what are we going to be covering today? We're going to be covering why a trading journal is important to live trading. And then we're going to also be covering how can a trading journal help us improve as a trader, and 5 do's and don'ts when it comes to keeping and tracking your trades. So I think with trading journals, it's something that, as I said, not many people do. I mean, Tyron, how many people do you think actually keep a trading journal past 2 weeks?
Well, probably about 1 in 10 go past that. And ironically, the 1 in 10 are the actual successful traders most of the time. You'll find that the people who do make it as a trader or turn into a professional trader definitely keep trading journals, because that's how important it is. And I know it's very easy to overlook, and a lot of people think they can keep these sorts of things in their head, but believe me when I say it's not that easy. And what a trading journal does, as you'll learn throughout tonight, is actually keep you accountable to what you are doing, whether it's actually right or wrong. So we'll go through a couple of examples later, but it is a very, very important process.
Accountability is the #1 thing in trading. It's way too easy to just shake off a trade and forget about it a few days later and then make the same mistake 2 months later without learning from it. So I think that's probably what stops most traders being successful. They often don't learn from your mistakes. And you always hear it time and time again. People say, learn from your mistakes and it'll make you better at whatever you're doing, your job or of course trading. But often I find that unless we're keeping a trading journal, it's very difficult for us to learn from our mistakes because we forget what they were, or we choose to forget what they were anyway. So why is a trading journal important for us? Well, obviously it helps us validate our strategy. And this is probably another very important thing about our trading systems. Most people will have multiple trading systems, but they'll also jump from trading system to trading system. So what often happens is you might have some success, let's say in a trading demo or even live, and the first 1 or 2 weeks or 3 weeks were just great, and then all of a sudden your trading system stops working for whatever reason. Now, without doing a trading journal, without keeping a trading journal, you're not actually sure if you are being consistent with your trading strategy. And this is very important because if you're not being consistent with your trading strategy, then how can you replicate that strategy? And a big thing that Tyron and I talk about is it's very well and good if you have $1,000 account or a $10,000 account and you're risking 1 or 2%. But what if that account was $1 million and you're risking 1 or 2%? 1 or 2% suddenly becomes $10,000 or $20,000, and it becomes a lot more real for people, and they can't be more consistent with their strategy because they may not have had a strategy that was validated for them to be able to scale their business.
Yeah, look, it is, and business is the key word there. Trading as a profession or even as a part-time, going concern is a business. It's not like, you can just buy and sell as you choose and think that you're going to keep how you did it and why you did it in the memory bank. What keeps you accountable is actually the ability to go back and actually check maybe, once a week or once a fortnight, how your trades have gone, the good and the bad, because you actually do learn from both types. And basically it gives you a step-by-step process to continually do the same correct methods over and over again. Now, the one thing about technical analysis and trading is that it is a repetitive form of what you do. So you have to repeat repeat, repeat. That's what makes technical analysis actually what it is, history repeating itself. So it makes sense that when you do come across a strategy that is working for you, that you follow the same steps, because that's the only way that you can really validate whether a strategy is going to work moving forward, if it is always done the same way. So it's a little bit like if you were running a business and you were keeping the accounting books up to scratch, which you have to do. A trading journal is no different. It's a business, and you have to basically treat it just like it is. It keeps you accountable to either your mentor or to someone that you're actually learning from, because it gives them the idea of why you place a trade, how you placed it, what happened in the market to cause you to buy or sell a position. But it also most importantly, keeps you accountable to yourself, because realistically, most traders, look, we train hundreds and hundreds of traders, aspiring traders. Some are good, some are terrible, and the bad ones are the ones that generally, think they probably remember what they've done, and they basically change their strategy to suit the situation or suit the trade, and that's not really something that is sustainable. What a professional trader will always do is have a strategy that is sustainable and repeatable, no matter how many times it is done the same way. Can it be tweaked? Well, of course it can, but that's where the journal comes in. That's when you're going over what you've done in the past, gives you the chance to actually tweak what you have done, what could work better, what does work well. So it's another reason why they're so important.
Yeah, so validation of your strategy is definitely a big thing to do with validating for your own psychology as well. So you don't take trades out early, and you don't let maybe trades run past where the stop loss areas should be. So really, a trading journal also helps you track your progress when you're trading. And the thing about tracking your progress is that it makes you, again, accountable, something we'll always be talking about, but it also means that at the end of the month, you're going to be able to sit down and you're going to be able to take a look at your trades for that month or for that week or for that fortnight and find ways to improve your system and to refine your system. And a lot of systems, they can start off and they may only be 55 or 60% winning kind of systems, but by doing this trading journal, by keeping yourself accountable, and by doing the hard yards where every month you sit down and you spend a few hours looking over those trades for the month, will help you improve it. And I think in anything in life, if you want to be better at anything that you do, you've got to constantly refine your systems. If you're working for, we've all worked for different types of companies, but you'll find that some companies have great systems in place. One I know a friend works for, which is Toyota, amazing systems. And they're very good at systems. Their entire business is just structured around systems and constantly improving and refining that. So it's the same with trading. So of course, we want to become also accountable for our trading decisions, and that's really where the trading journal comes in. So what I want to do with Tyrone tonight is we're actually going to take a look at a trade in the market today, and we're just going to take a look at the way that we might be able to actually snapshot this trade, and just one piece of software that we use to take snapshots, but obviously there's many other different ones. So we'll firstly just jump in before we talk about Presic, and let's take a look at the live markets right now. So here we have the Euro US dollar daily. So what Tyrone and I like to do, or we always recommend to people, is when you're looking at your technical analysis, you're obviously going to be drawing things like support, resistance, putting indicators, whatever your system may be. So you might have a chart that looks something like this. You draw up your support level. You might draw a Fibonacci on this particular chart, things like that. Once you've done all of your technical analysis, you can use programs. We use Snagit here, but you can use what's Windows snapshotting tool, and I think, or snippet tool.
Yes, the clipping tool, the snippet tool comes free with Windows 10, which is actually quite good. Yeah, I think if you put in the little search on the bottom, snipping tool, it brings up the software. It's actually very good. They're all really the same. All you need is something that can allow you to draw all over the chart that you're looking at and really put as much information on as possible as to why you are considering taking this trade. Now, even that could include little notes as well. Like you can put little notes to remind you. The more information that's there, the less you have to worry about remembering.
And then a lot of these tools will also allow you to highlight zones. So you might select, let's say, a color or something like that. Maybe yellow is your color where your entry point zone is. And then you'll know that every single time you go back over any trade journal that you've ever looked at and you're looking at your trades, you'll be able to see, oh, the yellow highlight is in this zone. That must have been where I entered the position.
Yeah, it's always a really good idea to get yourself familiar with whatever color you choose. It makes no difference what color it is, as long as it has a meaningful distinction for you. So red will generally be where you'll be putting a stop loss. It's just what we do. Green is a great color to use for take profit, because it's very, very easy to distinguish where your stop loss is and where your take profit is. So we can see here. We can see here on the chart. Let's have a look at what we've got here.
Yeah, so what we've got here is we've got our yellow, which is potentially our entry zone off this role reversal area. We've got our red area, which may be our aggressive kind of stop loss behind this swing up here. Some people will obviously place their stop losses above even higher swings, but this is a bit of an aggressive stop loss, that's fine. And then we have our green area, which is our potential take profit area. So whenever we're placing a trade, really we should have an idea of where is our take profit most likely going to be, where is our stop loss definitely going to be. We definitely need that. We've spoken about that several times. And we've got our entry point. And when we place the trade, what we want to do is we want to be accountable to that trade. So this is just the entry criteria and why we're getting into it. And what we might do is we might write something like here, and we may say entered off roll reversal, let's say, area, okay? And other things we'll put in maybe a few different points or measures. And by doing this, this can take, I mean, how long, Tyron? These literally can take 30 seconds to make. And I think
when you know what you're looking for, it only takes 5 or 6. Even like if you spend a minute or two drawing it up, it'll save you half an hour of thinking about what you did and why you did it later. And the thing is, like we said, technical analysis has a tendency to repeat itself. So when you come up with a strategy that is working for you, it's very easy to go back and have a look at why this worked. But just as important, we can list all sorts of things here. We can say which indicators we're using, why we're using that indicator, is it showing some divergence, what patterns are we seeing? So Thomas talked about the roll reversal area here. Do we see a candle pattern that is actually giving us a signal to go short? Just for everybody's information, we're obviously going short here because the stop loss is above our entry point. It should be fairly obvious for people who have done our webinars previously why we would be shorting here and not longing. But we've just gone to time frame.
I've just gone to, oh, sorry. Yeah, if you'd like me to stay on the daily, I'll stay there. There we go. So why I was just going to that shorter time frame quickly, Tyron, was because I wanted to show people that sometimes also with these snipping tools, what you can do is maybe you've got multiple reasons to be in that trade. So you can then go down to, in this case, the 1 hour, you can drag a certain area, snapshot that, and then copy and paste that just quickly into maybe your picture. And then again, you just draw maybe a line to it. You just say whatever kind of pattern you're seeing, and you just say on the 1 hour, that was my entry criteria. So very quickly, we're bringing multi-time frame, we're keeping a journal of what we're doing, and more importantly, we won't forget what's happened. And this can be so quickly. I mean, you saw how fast I copied and pasted that. I could put some quick highlights in. And as long as you keep, the thing with trading journals is it's all about how long is it going to take you to write it up. Because the reason everyone quits in 2 weeks doing it is because they spend half an hour writing up the trade, then they've got to go and do a retrospect whether the trade was successful or not successful. We find that a lot of people don't put in the non-successful ones because maybe it's a little bit too painful to write it up. I think that's something we see. And by doing it this way, we can just basically save this as maybe Euro US dollar, August 21st entry. Save it into the folder. The folder's name is maybe just the month, August trades, and then at the end we can review that.
Yeah, depending on how many currency pairs you're looking at, you can generally get away with one folder and say, like, just call it, say, August 2018 and put all of those trades in there. But for those of you who are a little bit more aggressive and have many currency pairs and do, a lot of trades, it could potentially be even better to break down that one folder and actually have the different currency pairs inside it to make reference points really, really quick and easy. Because at the end of the day, we only need 2 screenshots. We need the before and we need the after. Okay, so it is very important to do the after, and like Thomas alluded to, it's just as important to do the ones that fail. In fact, it's probably more important to do the ones that fail, because they're actually the ones that you will learn from. Okay, I know it's a lot of fun drawing up something that was actually successful, but drawing up something that actually fails, is what will teach you, what potentially could have gone wrong. And look, quite simply, sometimes you may have done everything 100% correct. It doesn't mean that it's always going to work out. Technical analysis isn't a perfect mechanism, but it certainly puts the advantage in your favor. So it's just as important to review the bad ones, and just make sure that you haven't actually made any mistakes. That's probably the key there. Make sure that you haven't made any mistakes for future trading. And once you've done this enough times, you'll find that you probably didn't make any mistakes, and it was just shit out of luck. So sometimes that's just going to happen.
Yes. Well, that's right. And look, we're just showing you a way of doing a snapshot, because we're doing technical analysis. Obviously, this is the visual way of looking at the markets. But some people do Excel spreadsheets, and they add in things like how many points they may need. You'll hear us talk about points in a second. And then they marry them up together. So they've got their technical analysis snapshot, they've got their quick Excel spreadsheet where they've said, yes, I've got these things. And they save both files and put them together. And it's as easy as that. And then at the end of the month, you can look over it. And I think one thing that Tyron and I also had is, of course, we were lucky when we were beginning our trading journey, that I guess we had each other to bounce ideas off. And I hear it from a lot of people when we train them. They always say, oh, I don't have anyone else to talk to about my trading experience. So if you can get hold of somebody else with a like mind or is interested in trading, it can be good for both of you to basically sit down and to maybe have some beers or just have some drinks at the end of that month, and potentially, even if it's over the internet nowadays, go through your different trades, because it does make you very accountable and it can really improve the trading experience.
One thing I also highly recommend, and I know we do it almost automatically now because it's an important part of the process, but it's also to try to identify not only why a trade looks like it's going to go in a certain direction, but also to put the boot on the other foot and actually try to identify things as to why it may not go in that direction. And maybe even put them in your journal when you are drawing it up, just actually writing in what could potentially go wrong and why it may go wrong. And that could be as simple as having potentially a support zone quite in between where your take profit will be on a short, or potentially a key moving average. Anything that you think could be an obstacle for this trade, it's not a bad idea to actually list it down. So what that shows you and tells you is that you actually identified potential obstacles, because it is very, very important to have a clear path when you're entering a trade, to make sure that there's not a lot of significant obstacles in your way between where your entry point is and your take profit is. So listing down any potential things like that is actually quite an important process, because it will make you think twice about which trades you're placing and why.
So just as an example of what Tyron's talking about, let's say we were to sell the market here, and our aim for, I guess, a take profit might be down here on this next support. So what we could put as a potential obstacle would be this area here, where the previous support was found and the market started buying up off it. So we could then highlight that, put that as a potential obstacle, and then go back to our system at the end of the month, have a look at that and see how maybe we find that every single time it comes down to this, in this kind of scenario, it comes down to this support, we notice that the market retraces and we can't handle that psychologically in terms of having our order on, and we end up taking maybe profit off here instead. So what we can do to change that is maybe we say, okay, well, we've got one contract or our trade on here, maybe let's take off a quarter of the size or half the size here and let the other half of our order go to full completion. So these are things like where you're refining your system, and trading journals help you do that. And you're always learning in trading, always learning.
Yeah, we've been doing this for a long time now, and the market still surprises us on a daily basis. So I don't think that you'll ever be immune from actually learning new tips and tricks. And that's why, journals, look, to be perfectly truthful, if we keep a journal for every trade we place. We keep a let's call it a modified journal now. We don't actually have to go into the big specific details because we're not learning. We know we have a very good understanding of what we're doing and why we're doing it. So we do take the snapshots like we showed you here on the screen, and the after shot, just to really keep us sharp and focused on what we are actually looking for. Because the one thing about as you do gain confidence and you do become, more adept at trading, you will inevitably get a little bit lazy. And then when you do start getting lazy in your trading analysis, that's when you start to make the silly mistakes that you probably shouldn't. And that's why the journal does keep you accountable. There's no question about that. And I know we're going to go on about it, and people are going to say, "Oh my God, are you serious?" But we are deadly serious. This is the key to actually being a professional trader, because if you think you can do it without it, your luck and memory will only hold out so far.
In many ways, this is the boring truth that you must do this kind of thing. It's like any job, there's going to be a part that you don't like, and a lot of people don't like this bit. And actually, we had a student that's just started with us recently, and he's been very good at constantly drawing and keeping his journal up to date. And his improvement over the last 2 weeks has been amazing. So it really does just show that where he's come from to even where he's now, because of keeping that trading journal. I mean, he's got 10 trades, I think, right now, but every single time he's doing that, he's improving his analysis because he has to look over it before he sends it to us for us to look over. And I think he thinks if he's making a mistake with that, he might be embarrassed or who knows, but it's keeping him really agile, and he's improved a lot. So Tyron, do you want to talk about creating a business plan for your trading strategy and I guess what we call the pressing system?
Yeah, sure. So we created the pressing system really to make sure that we stay accountable for every trade that we place. So it is like a journal, but it's more an accountability system to make sure that we've covered every component of what can go right and wrong for a trade. So we start out by the first P being price action. So by price action, we're talking about what is the trend actually doing in the time frame that we're looking at, in the time frame above and below it. If we're looking for a long position, is the current trend on the time frame we're looking at starting to go long? Is the one, more importantly, in front of the time frame going long? Just making sure that we have got price action on our side, because the thing is, price action is the best leading indicator there is. What price is doing is the most important thing. Now, the categories that fall into the price action are things like candle patterns, because candles are basically preempting what the market is doing right now and what could potentially happen in the next candle or two. So whatever time frame you're looking at. So if we're on a daily candle, the candle that we're looking at, the buyers and sellers action is telling us exactly what's happening for this day. And the patterns that are forming potentially telling us what could happen in the next couple of days. So the price action is very, very important. Then we move on to the next section, which is the R, so risk management. Obviously, we don't need to tell you how important risk management is in any part of a trading system. But in this particular instance, in our pressing system, risk management is talking about where you're placing your stop losses, how many obstacles we have in front of our where our take profit is compared to where our entry point is. So we're really focusing on things like, potential resistance in front of us, moving averages, Bollinger Bands, those sorts of things that could cause us a little bit of grief to reach our take profit. On the flip side, we're trying to place as many obstacles as possible between our entry point and our stop loss. So that works in an opposite way. So where we're entering, ideally we want, a support level behind us in between where we've entered and where our stop loss is, moving averages, anything that could actually halt price from actually hitting our stop loss. And just as importantly, risk reward ratios. Okay, so yes, what we're looking for here, where our stop loss is and where our take profit's going to be, we're always wanting at least a 1-to-1 trade. Ideally 2 or 3-to-1 trades are, what we're really seeking, because they're the ones that really, bring home the bread, if you like. So to give you, are you going to give us an example on the chart?
Example of that. I just want to show, if somebody has, let's say, placed a trade here, and then they're placing a stop loss level above this area here, and then they're taking profit down here, is that going to make sense in the long run for your trading? Well, it's most likely not, because what that is saying is that we have entered here, our stop loss is going to be 232 pips, and our take profit is going to be 180 pips. Now, the problem with that is long term, that is not one-to-one. If we placed $100 risk on this trade, we won't be getting $100 return. And with a lot of trading systems, you really want to be trying to look for at least one-to-one or potentially two-to-one style trades. So that's what we mean by that risk management and the risk reward ratios.
Of
you want
course,
to talk a little bit about go.
Okay, so I mean, we've covered that that's pretty straightforward. Okay, but if anybody's got any questions on that, certainly, if you don't understand how that part works, certainly fire in a question, and we'll have a bit more of an explanation of it at the end. Okay, so then we move on to the E. So the ELD 363 system is one of our proprietary systems. It's going to be a little bit difficult for people to understand if they haven't actually got this Pressix system to use. But what that basically talks about is multi-time frame. It looks at the time frame directly above where you're trading and the time frame directly below it. Okay, the one directly below it is where you're entering the trade. You're looking for the pinpointed entry. The one above it is actually giving you the directional momentum to make sure that where you've located the trade is going to go in the direction because it's got momentum on both sides. Okay, then we'll move on to C, which is the chart patterns. So we're going to look for any chart patterns that are present. So that could be anything from a double top or a double bottom, potentially a head and shoulders or an inverse head and shoulders, triangle patterns, flag patterns, all of the fun patterns that make the trading world go around. A lot of people seem to think that patterns don't work out all that much, and basically double tops and double bottoms don't work. Nothing could be further from the truth. What actually causes double tops and double bottoms and head and shoulders and all of the patterns actually not to work is actually the patterns that appear in the wrong places on the chart. Okay, there are double bottoms and there are double bottoms. So what you really want to identify are only the quality patterns, and don't just take double bottoms because it looks like a double bottom. There's a lot more analysis that needs to go into it, and that's where the Pressix system comes in. It forces you to identify more clues as to why a potential pattern may or may not be strong. Then we're going to move
just
on.
Quickly shown
go on.
Just
Sure.
quickly, a head and shoulders pattern on the weekly on the Euro US dollar. Now, it's obviously a very big head and shoulders pattern, but that's the kind of thing that you can add into your business plan and therefore your trading journals.
Yeah. So this head and shoulders pattern is actually a pattern on top of the trade that we were drawing up before. So just if anybody who is interested, yes, that's a head and shoulders that has already previously broken the neckline and has had a bit of a retrace now. So it fits in with the trade plan that we were looking at before. So then we move on to indicators. Okay, so look, we purposefully don't look at indicators until all of the other things are out of the way, primarily because indicators are just that. They're an indication of what the market may or may not do, but you certainly shouldn't be trading on the premise that an indicator says so. Okay, so we don't trade because there's a moving average divergence or a stochastic crossover in an oversold or an overbought area. That is primarily telling us that what we're already identifying in the market as a potential trade has more backup, and that backup comes in the form of an indicator. Okay, so we never ever trade on the basis of indicators alone. We use them for exactly what they are, an indication of what price may do. If they agree with the direction that we're looking at, it's a big tick and we can put it in our journal. If they don't agree, it doesn't mean that we're not going to take the trade, but it means that it may have a little bit less evidence in its favor to actually work out. And obviously, the more evidence that we can put in our favor, the better chance the trade is working out. Okay, now charting techniques, the last one of the Pressix system is things like Fibonacci retracements. Like, do we have a Fibonacci pullback in our favor on a time frame that suits? Do we have a trend line? Do we have an ascending or descending channel? That's what charting techniques are really identified by support, resistance, channels, and Fibonacci. So really, if you have any of those things in your favor, which you'd hope you would, if you were, most trades you'll find will have something in your favor, or I'd like to hope so. And the reason why we follow the Pressix system so closely is because if we can get one piece of evidence in our direction from each of these symbols, it's really giving us a very, very broad picture of what the market may or may not do. So if any of these key pieces are missing from a trade that we're looking at placing, it just adds that little bit of doubt as to whether we've done enough analysis or whether indeed that trade has enough going in its favor. So it's a really, really good idea to get a piece of all of these information, really. And if you've got a little bit in your favor on all of them, that really makes the trade a lot more sound than if you're only just got price action on your side, or if it's just a chart pattern. And that's what I was saying before. Chart patterns alone do not cut it.
Yeah, so I think what we're trying to get to here is that by doing the trading journal, by keeping up to date with the trading journal, that you're going to be able to build a complex business plan with your trading system. Because what will happen is you'll start with something, you'll start with an idea, and as you're refining that idea and as you're coming up with other solutions or reasons to be in those trades, you're effectively creating something like a pressing system. You're creating your trading strategy or business plan. So why obviously that's so important is because it gets you to, I guess, success. But what we also need to do with our trading journal is we need to follow a few different steps. So one of the steps, or I guess step one is, and I see a lot of people make this mistake, is set realistic goals. A lot of people get into Forex, they see something like some guy make 10,000% in a year, and they go, that could be me, how easy is that? And they get into a demo and it might even work in the demo, and then the live account starts and it becomes very obvious very quickly that maybe 10,000% in a year is not so achievable, at least straight away. And that's where I think setting realistic goals is, and keeping yourself accountable to being able to scale. As we said before, if you have $1,000 or $10,000 or $100 in an account, risking 1 or 2% may not seem like a lot. But all of a sudden, if you had $1 million, you may change your trading strategy, and therefore you don't have a scalable business, and your trading journal or your trading system will be showing you something straight away that isn't going to be scalable, and therefore you may not be able to be successful in trading. So by saying set a realistic goal, please don't set, I'm going to make 10 or 15 pips per day. Who did that? When did we do that when we first started, Ty?
Yeah, everybody does that when they first start, or even worse, a monetary goal, and that might be I'm going to make $50 a day or $100 a day. Damn it, no matter what, and it just does not work because it's not realistic. No. Because what that forces you to do is trade different contract sizes that it just does it it's a disaster waiting to happen. So you trade when the trade is there. And yeah, the one thing you'll learn very, very quickly is that you can't set a predetermined amount to earn every day in the market, because it's just not the right way to trade. Professional traders don't do that. There's going to be days where you're going to make 10 times what you thought you were going to, and there's going to be days when you're not even going to enter a trade because the market simply is not agreeing with what you want to do. Okay, so don't set goals that are unrealistic. And be very, very realistic in what you expect the market to do.
Yeah, so like that's why we prefer, especially with our students, we prefer that they maybe set a monthly goal or a quarterly goal, because that doesn't put stress on them. And the worst thing you can do is put monetary stress or stress of having to, I guess, keep up with somebody that may be trading that's saying, I'm going to making $10,000 per week and all of these other things, because that puts a pressure on you to take bad trades. And as we always say, when you're doing a trading journal, when you're doing a retrospect and analyzing how you've done for a month over your trades, you'll find that actually knocking out the bad trades makes you successful. So taking less trades often is the best success that you can have in trading. Because if you had 7 winning trades that were 2 to 1 and 3 losing trades, and that's all you did in a month, 10 trades, that's going to be generally much better than someone that's taking 1,000 trades in a month and winning, even if they were winning 60% of them and losing 40% of them. They're taking so many trades, they're constantly going, and they're getting that kind of excitement of getting them out. But at the end, you're probably doing just as well as them. And that's the kind of funny thing about a lot of these trading systems, is that it's about knocking out the bad trades, and that's why the trading journal is important. So as you can see with step 2, enter your trade details, like we discussed before and after snapshots of your trades. So you really need to take a before and an after when you're doing your analyzing of the trades. So of course, step 3, analyze how you did, and then try to learn from your mistakes and refine your systems. So of course we want to journal and track everything if possible. Now, some of these things you're not always going to be able to do. You're not always going to be able to journal everything, but being able to journal just the basics of trades, even if you're taking a 30 or 40-second snapshot quickly, is the most important part. So trading is a constant learning experience. You must learn from your mistakes. Track each trade with a snapshot software similar to Snagit or Snippet tool, and record where you entered and exited. Focus on your strengths and eliminate your weaknesses if possible, and spend time going over your strategy, as we just discussed. So I think I just want to go back to this example with the euro US dollar in the market at the moment. And I just want to talk a little bit about it, because when you're planning kind of your system, or you're planning anything, why we're saying you refine your strategies is because what a lot of people would have done last week is they may have seen this big red candle here, and they may have said, okay, I'm getting into the market short. And then they have written it down, it looks successful, and then it's come all the way back against them to this particular area. And like Tyrone said before, a lot of trade journaling and trading in general is recognizing what might happen. If you're going to enter a trade at this position, there is a chance that this position reverses and goes back to this previous support and tests that area. And that's something that can possibly happen and may happen to you. And can you deal with that psychological pullback? This is something that you're going to be starting to plan in your trade journals. You're going to be able to say, okay, when I enter here, potentially the market may come back to this area. And that may be something that I need to be prepared for mentally. And a lot of trading is the
and it
mental
happens
game.
a lot more than people think.
Really
yeah, quite
does.
often when you get a decent break, the return to that area of that break happens a lot more than people think. So you really have to be prepared. If you've missed that initial break of that zone and you do try to join in the trend, you really want a good valid reason to actually join it, not because you see a big red candle, because yeah, very, very often you're going to get that retest of that level. Is that retest a great place to re-enter? Well, that's going to depend on the evidence that you see at the time. And this is why Thomas was going through to the 1 hour and the smaller time frames to see if we can see any clues as to whether this area now is going to hold strong and actually reverse the market back down to exactly where it came from and further on. So
maybe in this situation, I just brought up a 15-minute Tyrone. Maybe in this situation, what we're seeing is resistance formed up here at this 153.66 area, 153.6, and then we're seeing support formed at around this 151.12 kind of area. So maybe if this support broke on the smaller time frame, what kind of pattern are we seeing here, Tyrone?
Well, that's going to be, well, we've got nearly a triple top there at the moment. So, and that's on a 15-minute.
Exactly.
Yeah, so I mean, that's.
So what does that mean for us? It means extra potential confirmation towards our direction. So we're creating this as part of our trading system, but also we can add this to our trading journal to maybe stay out of trouble in the future.
And what's going to happen if that triple top does break the neckline? More than likely, the two moving averages are going to cross, and that's another piece of information that says the 15-minute time frame is starting to turn. All of a sudden, we're going to get a series of lower highs and lower lows. Bang! We've got evidence that that area is starting to hold on the bigger time frame, because of course every move starts from the smaller time frames, and this straight away is something that you snapshot, cut and paste like Thomas did earlier, and paste it onto the big one, because this is the true evidence of why you're entering the trade. You don't just simply short because the market's retraced to that level. We need something in the market to tell us that this area is a solid area. It's going to hold. It's not going to go up much further. And most importantly, the price action has turned around on the smaller time frames and is starting to look weak again.
I just want to quickly end up, I guess, this webinar before we answer some questions is with just sound risk management strategies. I guess we put this almost in every week because it's so important to have sound risk management. Be smart, of course, with your risk reward. 1 to 2% of capital is a good place to start when thinking about how much to risk of your account. And 1.5 to 1 kind of risk rewards, not 0.5 to 1 like we illustrated to you like before. And of course, we need to know when to get in and out of our planned situations. And by keeping our trading journal, we can refine our system so we do have an idea of if something happens in the future, what may happen, and we may have something in our trading system, like our pressing system or our business plan, that says, okay, in this scenario, because we've kept a trading journal, we know what to do. And then just the last one, identify stresses. I think I'm just going to keep bringing this one up. If you have other things in your life that are stressing you out, try not to trade. I cannot stress it enough. I have seen people blow up completely from making bad decisions when they weren't, I guess, mentally or psychology ready. This is kind of like warfare. You know, trading is hard. Trading is very psychological, and it can definitely take us for a spin. So it's better that you don't have too many stresses in your life when you're doing it. Try to be, active, go to the gym, those kind of things. Just like you hear with professional stars, they go and try to chill out and have holidays and forget about everything. And it's the same with trading. It's a stressful job or stressful profession, I guess.
Yeah. Trading, I can't emphasize enough, is like a business. If you owned a milk bar and you were having a bad day, you're not going to all of a sudden go and order the double milk supply for tomorrow because you're just annoyed and you're going to place an order. You're not going to do that because it's a business and it's not a smart business decision. It's exactly the same with trading. You don't go in there and just place extra trades because you're having a bad day thinking that maybe winning will make you feel better, because that's just not how it works. If you don't treat it like a business, it is going to hurt you. And quite as Murphy's Law would have it, when you are, going through a period of, maybe a little bit of stress or a little bit of annoyance in the outside world, the market is not going to make you feel better about it. In fact, there's probably a good chance it's going to make you feel worse. So be very, very careful when you are trading with, things on your mind, because you have to have a very, very open mind and be in a good place when you are trading, like any, important decision in your life.
I'd just like to hand it over to our moderator at Pepperstone and just see if anyone's asked any questions. If you do have a couple of questions, ask them now.
Yes, we do have a few questions. The first one will be, do you use your Excel RTD to export trade details?
Yeah, look, you definitely can. It's not a bad idea. It's really what you prefer to do. But yeah, Excel RTD is definitely something. I think I did a video on that a little while ago. So it's not something that we personally use, maybe a little bit old school, but you definitely can.
It really comes down to, I think, your ability with Excel. I mean, look, there are amazing things you can do with Excel, and if you've got like a little bit of an Excel background, you can really take it to the next level, and you can have hyperlinks. I know that we had a trade planning system that used to hyperlink the before and after shots on a trade planning sheet. So it really comes down to your expertise in Excel. But the most important, it actually doesn't matter if you're writing it on a scrap piece of paper with a pencil, as long as it's making sense to you. That's the most important part, and you can understand what you've done. So it really, that's a preference on your ability.
Thank you.
Yes.
There's actually an interesting one. Is there an alternative to the ELD 363 system?
Okay, so sure. The ELD 363 system, the ELD, let me just break that down quickly. The E is the entry point time frame, the L is the location time frame, and the D is the directional time frame. Okay, so that's what that stands for. Now, is there an alternative? Really, any type of multi-time frame analysis can fit into that mold. So it's really about, understanding when I say location time frame, that's where you've actually located where you would like to trade. The E component is the entry point time frame, which is generally lower than the L time frame, and the directional time frame is the time frame in front of where you're looking, just to make sure that the market is actually moving in the direction on the longer time frame that you're wanting the market to go. So that gives you a big boost when you're actually placing a trade. So to say, is there a replacement? I mean, all of our trading courses use the ELD system because it's refined to the point where it actually just tells you exactly what's happening with a click of a button. But if you want to replace it on your own, just use multi-time frame analysis using the bigger time frame and the smaller time frame around the one that you've located your trade, and that will take care of it for you. That's how you can replace it.
Yep.
Okay. And what would be the most used technical analysis from pro traders?
The most
Price
used
action.
technical analysis.
Yes.
Okay, so when you we as traders have actually identified what we consider the most useful indicators, chart patterns, and candle patterns. And look, there are millions out there. I'm sure everybody's well aware. There are thousands of indicators, thousands of different names of candles. There are candle names that I haven't even heard of. But we've actually nutted it down to about 4 or 5 that actually work well together. Okay, and look, the best way to answer that is to probably get people to go and review some of the webinars that we've done, because we've actually done full webinars on all of the indicators that we use, all of the chart patterns that we use, and the charting techniques that we use. But we do keep it very, very simple. So in regards to chart patterns, double tops, double bottoms, head and shoulders, flags and triangles. Indicators, we only use moving averages, stochastics, MACD, Bollinger Bands, and RSI. And charting techniques, Fibonacci, trend lines, channels, support and resistance. It really is as simple as that. You don't have to overcomplicate your trading, and we find that those ones are the best that work together.
Remember, you're not trying to change the world. What you're trying to do is get as many reasons that are logical to be in a trade, because that's what the big traders are doing. That's what the guys with billions of dollars are doing. When they place trades, they're trying to find areas that make the most sense to them for placing those large orders and then adding into the system. Because a lot of people don't realize that they don't just press $1 billion into the market. I mean, someone might, but they generally don't. What they're doing is they're adding to their orders because of things happening in the market that are completing what they already thought was going to happen in their direction. So that's why the market moves. They're adding and placing extra orders in the direction they want. Warren Buffett doesn't just buy Coca-Cola shares and then say, I'm good with Coca-Cola, I've bought my shares. He adds to his position over time strategically. I think one of the most recent ones was Apple. He did it recently with Apple. He's added to his position because he's happy with their results and happy with their movements. So it's the same kind of thing when we're approaching any type of trade. So I guess, are there any other questions that anyone's asked?
Well,
We've got more time.
yeah, so the one that we have here is, how do you develop your trading psychology using your trading journal? For example, if I'm fearful, greedy, how and what do I write in my journal that would make me less fearful or greedy?
Okay, that's a really good question, and that's probably one of the main reasons why you actually keep a journal in the first place. Because while a journal keeps you accountable, the best way to get rid of fear when you are trading is to actually take away the one thing that you're scared of, which is actually losing money. Now, and that's why the risk management component of a journal is so important. Now, and by that I mean, if you're trading a $1,000 account and you were risking only 1% of your trade, you're only ever going to be exposed to losing $10 on a trade that could potentially go completely wrong on you. Your worst case scenario is going to be a $10 loss. Now, on a $1,000 account, that's not a lot of money, because that's going to, if you're going to lose $100, for instance, on a $1,000 account, I'd even be scared of that, because that's going to take you down 10% of your balance with one bad trade. But if you keep your risk management correct, which is 1% probably as a maximum, you're only ever going to lose $10. Now, so that should get rid of the fear for you. So if you're trading within your limits, and no matter what, that doesn't matter what size account it is. If it's a $10,000 account, then you're only risking $100, and if it's a $100,000 account, you're risking $1,000. Every one of those trades would be placed exactly the same. And the idea is to keep the risk low to make sure that you're actually not fearful of losing money. On the flip side of that, the greed component is actually setting very realistic take profit targets. Now by that I mean not saying that I want to make $100 every day, saying placing a take profit exactly where it needs to be. Every trade that you'll place has a predefined take profit, especially when you're trading a pattern. So you don't increase that because you need to make more money, or you don't increase the lot sizes because you need to make more money from that trade. You need to keep it in a very, very realistic boundary. So you know, every chart pattern you'll look at, every entry point has a very realistic take profit. And that will take away the greed component, because you must let your trades play out. You must let them go to their take profit or to their stop loss. If you start interfering, then all of a sudden your system will start to break down, and then, you know, the fear and the greed will kick back in again. You've got to treat trading exactly for what it is, a very mechanical process, and take human elements out of it.
I'll just leave everybody on this, because we always work with Pepperstone around these things. Look, if you're lucky enough to be in Melbourne, was the most livable city in the world, we have a live workshop that's going to be coming up in September the 19th at 6:30. So you're welcome to jump over to fxevolution.com/FXEvolution workshop. And if you're interested in attending that event, it's 2 hours. It's obviously free, and you can come in and we'll talk about these things, but we'll also talk a lot more about trading systems and strategies. So we'd love to see you there if you're in Melbourne.
We are going to break down the pressing system right down in that workshop too. So anybody who's got a bit of an interest in the pressing system, we're going to break that right down and show you how it really works.
Oh, sorry guys, could you just let us know, there's lots of people who would like to get a copy of this webinar, where they can find it.
Yeah, so I believe Pepperstone actually uploads this webinar after, so they should be available on Pepperstone's YouTube channel, I believe is where it goes.
Yes.
But it is definitely available. And anybody who can't find it, just contact your client service representative at Pepperstone, and they'll definitely be able to give you a copy of this. But also for the people who haven't seen any of our previous webinars, all of them have been recorded, and yeah, a lot of them touch on some of the things that we've talked about tonight. So yeah, feel free to talk to your advisor there, and they'll be able to put you in the right direction and give you a recording of all of our webinars so far.
Excellent. All right. Well, thank you very much for joining us again this week. Next time, hopefully, we're coming with a little bit more Learn It Live.
Excellent, guys. Thanks again, and we'll talk to you very soon.
Thank you.
Thank you.